Imbalance is something most traders absolutely ignore, yet institutions literally rely on it. In this video, you're going to learn one of the most important market concepts, and that is imbalance. This is the reason price moves so aggressively, it's why we get so many retracers, and it's one of the key tools that we use to anticipate exactly where price is likely to react from. I'm going to be breaking down exactly what imbalance is, how to spot it on your charts clearly, and how we use it within our trading. So if you've ever struggled with your entries, wondered why you've got wicked out, or wondered why you've entered a position and it's retraced fully to your stop loss straight away, or you've just wondered why price revisits certain areas. Now, once you understand imbalance, it's going to completely change how you see the markets. Now, I've got a bit of a drawing on screen and I'm going to show you exactly what imbalance is in a moment. But basically the reason why we get imbalance, it's when one side of the market is very, very dominating over the other. So it's where there's an imbalance in between the buyers and sellers. So if we get a very sharp movement up where the wicks don't really overlap each other and you get very strong full body candles, that's what we call an imbalance, where the buyers have dominated that part of price. Now naturally what we find is before price moves in its intended direction, it will want to come down and rebalance that price before it then moves off. It can be a very powerful way of understanding what price is going to do. Sorry to interrupt the video that you may be watching at the moment, but this is just a quick friendly reminder to come and join our Discord. I will leave a link for it in the description below. Not to mention the VIP exclusive side of the Discord, which goes live on the 1st of March. And that's if you're maybe struggling to stay consistent, you maybe haven't reached profitability in your trading, and you can just generally trade a lot more closer with us. You're going to have our 24/7 support. You're going to get access to the exact trades that we take, how and when we take them. And also you're going to get access to a ton of resources, so blueprints, cheat sheets, everything you need to take trading into your own hands. I'm a big fan of the quote, you can catch a man a fish and he'll eat for a day, but if you teach him how to fish, it will feed him for a lifetime. And that's the exact philosophy that we're taking with this VIP Discord. We are not here to do the trading for you, we are here to teach and educate you about trading so you can take trading into your own hands. So as I said, I will leave a link to that in the description below, so come and check it out. And with all that being said, I will let you get back to the video. So you might have heard people talk about imbalance before, but they might have just used slightly different terminology. So what you might have heard before is people say this is an efficient price range, or there's an inefficiency here. That basically just means there's an imbalance. So when we get an efficient price range, it means there's no imbalance. And when it's an inefficient range, that means price has got to come down and correct it. So we normally get imbalances with inside a big impulse. So if we have a short, sharp move up within price, that's likely going to contain some imbalance. Now I'm going to show you exactly how to spot it. So in here, we have, ignore the bearish candle, but between these bullish candles, you can see there's a gap between where the wicks, either side of the middle candle, don't overlap. And that is a gap which is called imbalance. Now, if this was classed as an efficient price range, so there wasn't no imbalance here, we would need to see this. So if this wick here, if this wick came up to here and this wick came down to meet it like that, that's what we call an efficient price range. That means price is now balanced in that area. But as soon as we get a gap where the wicks either side of a given candle don't meet, that means there's a gap there and price is naturally going to be attracted towards it later on to come and correct it and rebalance that piece of price. Now you can see how this is going to be really, really powerful within our trading, because if we have a supply or demand zone directly before a piece of imbalance, that means price is going to want to come down firstly to correct this piece of imbalance and tap the zone. So that gives us a very good indication of that the zone that we've got marked up here is the right zone for a start, and one that we're going to see a strong reaction from. Now, one thing I forgot to mention is some people might also call these fair value gaps, and it just means exactly the same thing. And also what you might be thinking is, well, why does price have to come down here? Why can't it just carry on? Well, when we get imbalance, like I said, it means that price has been overwhelmingly dominated by either buyers or sellers. So that means when you get a gap, there's leftover unfilled orders at those gaps, especially from institutions and investors, where they haven't quite managed to fill all of their orders. So when price comes down to fill those gaps, all those orders automatically get triggered in, and that's why we get such a strong reaction from them. And when we have those aligned with a supply demand zone, it's just extra confluence that we're going to see such a strong reaction from it. As well as filling all of those unfilled orders, It also gives institutions and investors who missed the trade the first time round a good price to get into. So before I take you on to the actual charts, which I will do later on, I'm just going to run through a couple more drawings to show you what it would look like with inside a trend and how we use it within our trading. So this drawing I have on screen for you here is how we use imbalance within our liquidity supply and demand entry model. Now, what we look for, as you know, is we look for a sharp move up that leaves behind the imbalance. We then want price to come close to the zone but not touch it. That's the liquidity part of the strategy, and then we want to break the structure of that liquidity, so break this high. That tells us that a load of traders did get in at this point. And then once we break that high, we then want price to start coming back towards our zone. Now, retail traders and normal supply and demand traders will see this point as the key area of interest where they're going to want to get in. But we know, because there's imbalance left behind right below it, that price is much more likely to come and fill that imbalance. So, which means that when price comes through this zone, all of the traders that got in here, the normal supply and demand traders, they're going to get stopped out, and then price is going to come down to fill this imbalance. And because there was so much liquidity below this low of all the stop losses, that's going to create enough orders and enough contracts to come available for the institutions to get in at this point to make the bigger move off once that imbalance is filled. So if all of this second leg here, if that's all efficient and there's no imbalance, price has no need to react from it. Whereas we know that when we trade imbalance, that price always seeks to fill it before it moves off in its intended direction. So we're expecting this demand zone to fail and to actually come down to the true zone where we get in once this imbalance has been filled. You've got to put yourself in the shoes of the institutions and think, well, why would they get in here when firstly all the price is efficient, there's no imbalance, but also when they could get a better price by taking out all of this liquidity, filling the imbalance, rebalancing the markets, and then getting a better price down here. So if, for example, this liquidity here came down to here, firstly, we wouldn't take this because the demand zone would be mitigated, but also this imbalance would also be filled, so there'd be no reason for price to come down here. So if there was then a demand zone here, that's when then price is likely to come from here rather than down here, because it's got no reason to go any lower because there's no imbalance and the demand zone has been mitigated. So it will go from the nearest demand zone as opposed to taking out the liquidity first. Now, the second and third way we use imbalance is what I've got on screen here. Now, the second way is that we use it to tell us whether the zone that we've got currently drawn on is the zone that we're going to go from or react from. Thirdly, it's our profit targets. We can also use imbalance as a very, very good way to understand where price is not only reacting from, but where it's likely heading towards as well. And that's where we can use it within our TPs when we take trades. Now, when we have a swing like this is obviously how price normally moves. We get higher highs and higher lows. That's an uptrend, we know that. And the two types of trades that we'll take from this is either a continuation trade or we will take the extreme zone. Now, when you get a strong upward trend like this, what you normally get is a load of imbalances left with it. And you normally get loads of demand zones left behind, and that's where a beginner trader might think, well, there's so many zones on here, which one are we going to go from? How do I know which one's correct? Now, that's what I'm going to talk you through now. Now, when we get a big swing like this, we will either go from the first zone, so the top zone, which would be a continuation trade, or we will go to the extreme zone, which will be the bottom trade. You always want to avoid any middle zones. So this zone here is a big no-no. I'm going to mark that in red so you know. And here's how we know. Because we don't know how big this leg of price action is going to be. For all we know, this could just keep on going and going and going and going. We don't know how big that leg of price action is going to be, so we want to take firstly the top zone, which is a continuation to that trend, and we're continuing with the trend. Or if the top zone fails, so if this zone fails here, you might think, well, why can't we take the next zone down? Well, that's how we know that this leg of price action is now over, because we've had a change in trend. We've broken this low and we've broken the nearest demand zone. And based on what we know about price, as soon as this leg is finished, so by breaking the most recent low and the most recent demand zone, it naturally wants to come down to fill all of the imbalance and then move off in its intended direction. So that's why if you've been taking these middle zones, you've been getting stopped out a lot. Well, we need to understand if there's zones below it, institutions are naturally going to drive price down to that. One, to get the better price, and two, to fill all of the imbalances before it moves off. So that's one of the ways we understand that the zone we've got drawn on is the correct zone. So to summarise, we will only ever take the top zone as a continuation trade, or we wait for the extreme zone, at which point when price meets that extreme zone, all of the imbalances are now filled. Price hasn't really got any reason to go any lower because there's no imbalance left. So that's when we can then start going back bullish to continue the higher time frame trend. And we've got to remember that if this is the 30-minute time frame, on the 4-hour time frame, this price will just look like this. And all it will be is just a part of a higher time frame swing where this will now just be the higher low. That's basically it. So we always look to either go for the extremes or the continuation zone. We never take any middle zone, so just bear that in mind. Now the third way we use imbalance is we use it to identify price targets when we actually enter trades. So for example, let's say we take this bottom zone here. What we can look for is any imbalances to the left, higher up, where price is naturally going to be gravitated towards to fill that before then moving off of it, before reacting from it. So if, for example, there is a price look like this, so like that, and there was an imbalance here, we can use that as a way to identify where price is now likely headed towards. So we can basically trade from imbalance to imbalance on either side. So if we look at this and see that all of this price range is efficient, all of this price range is efficient, price has got no reason to stop anywhere up here because it's all efficient price range. We're now looking for the next piece of imbalance that we can then target, and we can use that as a take profit line or TP line for our trades. So now I'm going to show you how we use imbalance, but in the context of looking at live charts. Now this was a Germany 30 trade that happened this morning, and we're going to go over our thought process behind it. So what we're looking at here is, if we look at this in the context of if there's where there's any inefficiencies, you can see here in this we're looking at this leg of price action here at the moment, and within this you can see this is all what we call efficient price range. All the wicks have met each other. There's no candles in here that still have an open body on them until we get to the point where our trade takes place. Now what we have here is we have everything that we look for. We've got the sharp move up. If I get my Pathfinder tool out, where's it gone? There it is. We get our short sharp move up. We then have our liquidity, which is 2 candles. It came close to the zone, but it didn't tap it. We then get a break of structure, and now we're looking for price to come back to the zone. Why do we know this is the right zone? Well, firstly, because all of this price range is efficient, so there's no reason for price to go down there at all. And we've also got a very key gap here, imbalance or fair value gap, whatever you want to call it, which is from the top of this candle here to the bottom there. So you can see, if I zoom in there, get rid of this drawing so you can see it a little bit cleaner. This candle here, this big bullish candle here, when we get the liquidity that came back to the zone, it didn't quite, those wicks didn't quite meet up. So there's still a piece of open body there, which means price is going to want to come down to fill that at a later date. So when we have this kind of imbalance directly above our demand zone, that's how we know we're going to get a very, very strong reaction from it. And that's how we know the zone that we've got drawn on is the correct one. So what we're waiting for is when price comes down to here. And you've got to remember, the reason we trade liquidity is that a lot of traders are going to have got in here. So whether they're support and resistance traders or whatever traders you want, a lot of traders are going to have got in here with their stop losses below this candle, which creates the liquidity side of the trade. So when we come down, which I will show you, we come down, we feel that imbalance, which is important. We then get a very, very strong reaction from the zone. That's our entry point. So our entry point would be on the zone here. As soon as it met the zone, our stop loss would go below the zone. So when we look at this trade, we can also use imbalance to see where we're going to target with this trade. So we've got our entry point, we've got our entry, and now we're looking to the left to see whether we can target any higher than this high, because we're expecting this high to get broken. We're in a bullish trend, so we're expecting it to get broken. So can we afford to go any higher? So, and if we look to the left, well, we can see there's some imbalance over here. This big old bearish candle created loads of imbalance, but when price came back up, it didn't fill it all, so we've still got all of this imbalance here. And if we go to the top of this high here, you can see from here to here is still unfilled. So we can target now to that imbalance there, because we're expecting that now to at least get filled. So you can see there, just because we've had an imbalance and a demand zone directly below it, that we've got that very, very strong reaction from the zone, and that's why we've been able to capitalize on that trade. So to summarize, imbalance is when you get that open piece of price action in the middle of a candle body that hasn't yet been filled. That's when price is naturally going to be attracted towards it to fill all the unfilled orders, to give opportunities for new investors and institutions who didn't get in the first time round, and to just generally rebalance price between buyers and sellers. And we can use it to firstly see whether the zone we've got drawn on is the correct zone. We can use it in our entry model, so if we've got imbalance directly above or below our supply and demand zone, that's a very, very powerful confluence that we know we're going to get a strong reaction from that zone. And finally, we can use it to decide where we're going to target within our trades. So we can use open imbalances to the left, higher up or lower down, to where we can target price with. So if you have any other comments about what imbalance is, how to use it and how to spot it, put them in the comments below and one of us will answer it for you. And if you like the video, don't forget to like and subscribe, and I will see you next time.